All right, good morning, and thank you everyone for joining today. We're very grateful that you could be with us. The session that we're having today is entitled Physical Climate Risk, Understanding Real Asset Value Impacts and Asset Value and Asset Valuation. And so my name is Matthew Olterino. I'm from the UNEP FI Secretariat. I'm very happy to be with you today, and I'll be moderating the session. We have three great speakers who I'll introduce in just a moment. They are leading practitioners in their fields. We have a globally diverse representation. So we have Carlos, who is normally based in London, not joining from Barcelona today. Jim from Canada, and in Toronto, and Mervyn in Hong Kong. We have structured this, and we hope this will be a very practical discussion about work that these individuals are undertaking and coordinating, and some of the things happening within their organizations, with a particular focus on real estate assets and infrastructure assets, and specific to physical climate risk, the ways in which chronic events, acute events, climate events are affecting asset values, and then more broadly how those climate risks start to ripple through the real economy and have macroeconomic effects that filter down to individual assets. So most practitioners certainly recognize that there's a need for more granular information and data, both about understanding the risk, but actually, really more about the pathways or the channels through risks materialize, the financial channels. So, how are asset values most likely to be impacted by physical climate risk? That is, will climate risks show up via disruption in income or operating expenses? Do they filter through capital expenditure issues, cost of capital, exit values, and so forth? And so having that more granular data certainly helps asset owners and managers in making their buy, hold, sell decisions, and planning for future climate variability. So part of the discussion today will focus on those data needs, but also the data gaps. So there's arguably a lack of empirical evidence on those channels through which risks will or have been materializing, and certainly that has impacts for how capital is allocated and capital decisions are made. It certainly also recognized that there are ways to mitigate the risk, and that's principally through insurance cover. But you can look at resilient design or hardening existing assets, and then also local area resilience or resiliency planning across a local geography. And all of these play a role in mitigating potential value erosion or value risk of real assets. So again, understanding these mitigants, how they come into play, how they can be supported, and so forth, is critically important for investors and lenders. And we'll spend some time discussing that today as well. So the emphasis, why the emphasis on real assets and real estate and infrastructure in particular? I mean, obviously there are similarities between those two asset types. They're capital intensive. They have long lives. They're immobile. They will be fixed in place, generally speaking, except perhaps for rolling stock for infrastructure assets. And so, reasonably illiquid and can be severely impacted by extreme weather, but also impacted by adjacencies. What else happens in the network? What happens close by to those assets? I think it's important to recognize as well that these assets certainly contribute to government revenue, or can do that. So via property taxes and user fees and so forth. But importantly, they contribute to economic growth and development for local areas. And so hardening those assets, planning for climate risk for those assets is critically important. So during the next 45 minutes or so, We'll have some presentations from the speakers, and then some questions and answers or a moderated discussion between the group. And so we'll hear some, or we'll get some information on current work that's happening from these practitioners within their institutions. In particular about understanding economic modeling variables and how that affects present and forward-looking asset valuation and capital planning. And then we'll also have a perspective on from the credit rating perspective on how physical risk starts to filter through, affect macroeconomic conditions and filter through the real economy, and how that might affect borrowers, whether they're sovereigns or sub-sovereigns, or at asset level or project finance for these type of assets. The speakers that you see on screen, we have Jim Clayton, who will go first. Jim is director of the Brookfield Center in Real Estate and Infrastructure at the Schulich School of Business at York University, based in Toronto, Canada. Following Jim, we'll have Carlos Sanchez. Carlos is a climate resilient investment director at Willis Towers Watson. He's also the executive director of the Coalition for Climate Resilient Investment, or CCRI. We'll go into CCRI in more detail during his presentation. And then lastly, we have Mervyn Tang. Mervyn is Senior Director and Global Head of ESG Research for Sustainable Finance at Fitch Ratings. Mervyn comes to us from Hong Kong. So welcome to all of you. In a minute, I'll turn it to Jim. Jim will give his presentation talking about research that's being done in collaboration with colleagues from University of Reading in the UK. And this is work that is being sort of co-sponsored by UNEP FI and our property working group. And it's looking at the evidence base for the ways in which extreme weather events have impacted real estate values and what we can learn from that empirical evidence base to do forward-looking projections. Carlos is going to talk about CCRI, and in particular something called the Asset Design and Structuring Workstream, or the ADS, pardon me. And this is a working group made up of infrastructure investors and owners, engineers, insurers, analytic providers, and so forth. And they've been working over the past year or so on modeling the operating income effects from climate hazards. Carlos will go into more detail about that work and the results that are coming out through that. And Mervyn will present some findings from a recent paper that has come from Fitch, but largely focusing on how climate change is likely to create macroeconomic effects, and by extension, how these filter through the real economy and affect credit channels, and therefore cost capital, cost of borrowing, access to capital for any range of borrowers. So with that, I'm going to turn it over to Jim. Each of the speakers have just a couple of slides that they have prepared to help illustrate their points. And each will speak for about 6 or 7 minutes. And so share the screen now. Jim, over to you.
Terrific. Thank you, Matthew. That was a great introduction. It's a pleasure to be here with you and Carlos and Mervyn. I'm really looking forward to this discussion with three unique perspectives as well in different parts of the business. It's kind of interesting that none of us are the investors putting capital directly into it. We're kind of part of the system that is advising on a lot of that, and in some sense regulating that to some extent as well. It's a great fit for me being here personally with Carlos and Mervyn in terms of the program I'm part of is pretty unique around the world in terms of being focused on both real estate and infrastructure together. And we have a real cities focus. And Matthew, you mentioned that, the the real estate, the infrastructure can add a lot of value by way of property taxes and help economies. But we know that two other things, too. Cities are the driving force of economic growth these days, increasingly so, but they're also the biggest contributor, real estate and infrastructure, to a lot of the issues that we're dealing with. So this whole sustainability idea, resiliency, ESG, and now climate change is just woven into everything we're trying to do. And the Canadian investors are really, really focused on this, a lot of them as well, as we've talked about. So just a few slides in terms of the introduction here about the work that Matthew mentioned that we're doing, again, along with a group of great colleagues from the Henley Business School at the University of Reading. We're working with Matthew and the group on just seeing what's out there from an academic perspective in terms of literature that's been looked at some of the, we could call it climate change impact, and that's where we're going to go. But originally, a lot of it is sort of focused on areas that are flooding, fires, hurricanes that people didn't originally necessarily associate with climate change, but we now know are increasing in incidence, severity, and even migrating into different locations. And it's changing, it's becoming real. So the motivation and goal of our paper was really just to investigate, first off, what's industry thinking? What are they doing out there? There is some work out there, specifically with the Urban Land Institute and Heitman around the world has put out a couple of different pieces in the last few years. There's a lot of increasing industry press, business press on this topic, indicating that some people are thinking about it, some aren't. Some applied research from the counselors group with their publication Real Estate Issues with some of the European research leads at AEW and other locations, partnering with academics to look at some of this. But none of it is really getting right at the impact on values and the potential channels. There's a lot of discussion. Matthew and I interviewed a lot of folks in the institutional world to see, are we bringing in climate change to investment committee? Is it coming in and affecting decisions on acquisition, disposition, CapEx and the like? Yes, it's there. They're talking about it. There's scorecards, there's screening, there are various things, but is it actually impacting values? That's really fuzzy. And the valuers themselves, the appraisers, we all know tend to be a little bit backwards looking because they need that confirmation. So there's sort of this chicken and egg thing going on, and we'll talk a bit more about that. But so for us, we wanted to look backwards. Is there academic literature that we can pull information from to tell us about the impacts of various climate or weather related events? How does that work? What are the channels? What are some of the other factors involved as well? Okay, next slide, Matthew, please. And then what did we find in terms of the summary of what we found? Okay, we found a very large literature. Much of it is historical and in sort of specialized journal on floods and various things. There is really interestingly, though, a number of things happening today where the research is now coming to the mainstream finance journals. And we'll talk a little bit more about that in a second, and economics and other journals, but the frequency's picking up. Most of what we found in the literature is focused on water, flooding, hurricanes in the US dominate, but increasingly also some wildfires, some information, some publications on heat and drought and the like, and temperature rise. But largely historically on flooding, though we're starting to see a real increasing focus on sea level rise. And that is really helpful and beneficial because that has a bit more of a forward view, right? We're trying to see is this being priced in? Most of it is very backwards looking. Also, almost all residential in the form of single family owner occupied homes. A lot of it originally more vacation type homes in the hard hit traditional hurricane areas on the US coast. But we are seeing some more CRE or commercial real estate studies coming. One of the biggest findings one of the biggest results we're finding kind of consistently, especially outside of the US, is that stuff happens, whether it's a flood, other related events, values are impacted, but they tend to bounce back. They tend to be in areas where people sort of know this kind of activity is going to happen on a recurring basis. There's a hurricane season, there's a flood season, it's built in. But a couple of studies that, especially looking at Hurricane Sandy in the US and some other events, are starting to really pull out some change. We've now got better data, right? We've got data at the transaction and property level data. And we have floodplain information. We have better analytics and ways to get at this and tease things out, starting to see more of a permanent price impact, even on properties that were not hit or impacted by the event, but are near. So a reassessment of risk associated with moving up the coast. One particular study really shows that commercial property impacted by Sandy started to see the same dynamics in Boston, because people are now starting to think that this could move up and affect things to some extent. Differences in beliefs, especially on a single family, come into play. We have a big discussion of that. Heterogeneous beliefs. Clearly, there's people that believe in it. There's people that don't. There's a big difference between folks that have that long-term view that Matthew was talking about, right, versus folks that are still getting in and out that are more transactional oriented. We have a lot of difference in that. Importantly, for real assets, it's not all about prices. Prices can be one of the laggards in reaction. It's liquidity first. The big thing we don't know is about the bid. Who's going to buy some of these properties in 5, 7, 10 years? That thinness of the bid might start feeding back to risk premiums and pricing, and we're starting to see some signs of that. Similarly, some adjustment by lenders in the US, and it'll be interesting to see where Mervin's going to go with his discussion, but the US has the securitized debt market. We're starting to see some moves by local lenders originating more mortgages that can not necessarily be held on the books, but are ready to be sold into securitized pools if those risks arrive. So as Matthew also noted, we have some data issues. We still can't sort of get exactly what we want, but it's coming. But there's a lot of I would say, of mushing of folks of these ideas that it's hard to separate out some of the CapEx. You might be spending money to make a building a lot more resilient. How does that impact the value? Those kinds of things. The last thing I'll point out is one recent study that kind of fits with our bounce back is top left of my slide is a chart pulled from a recent study by Sarah Rutledge and Jeff Fisher that appeared in Business Economics that looks at over the past 30 years the impact of hurricanes on commercial property values. What these numbers are showing is actually the impact relative to properties in metros that were not impacted. So it's a difference. It's not saying something went down 25% in 8 quarters. It's saying it went up 25% less, depending on which way. But the gist of it is that if you look at over 30 years, these bounce back. It takes time, right? But 20 quarters, 5 years, things are back to where they were. People kind of forget. That's changing now when we look at just the more recent hurricanes. That's the dynamic I mentioned. So forthcoming in about a month or so, Matthew, we think, our working paper. There's a lot to this, a lot of moving parts, and we're almost there. And with that, I'll turn it back to Matthew.
Jim, thanks so much. I appreciate the comments. It's great insight. So those of you listening in today will see a link on the screen. You can click that link and you'll and that ensures that you'll receive a copy of this research paper when it is available, hopefully very, very soon. We have been undertaking this work for some time. I mean, the literature base, Jim, maybe just a quick question, to try to bring it back to the region. We see some papers from Australia focused on wildfires and flooding. We have done this work, and the selection of papers is based on publications that publish in English. I mean, what's your sense of what's out there for the region? For the Asia Pacific region? My guess is there's more out there than we've identified, but maybe there's, we can say something about the lack of information actually is quite a feature of the market.
Yeah, no, it really is. To your point, Matthew, it's whether it's data availability, whether it's academics focused on those issues. Not exactly sure, but yeah, we've not been very successful in finding things specifically from the Asian region. We've had some comments on some things that we could be looking at in Japan and other areas, but we have not found those publications. So actually, we would be very welcome if if anybody here or in the audience has those to direct us to them, we'd love to get that in here. But my sense is that a lot of what we're finding carries over and is common to the thinking of investors and local governments around the world in terms of, you know, that importance of the resiliency that you were talking about, importance of the long-term versus short-term, and the differences of opinion about whether this is real. I think a lot of that does carry over. The one thing we did notice, and I'm guessing really carries over, you mentioned Australia, there's a big study there on valuers that we're still kind of thinking that there's this disconnect, this lag between what investors and what my colleagues here are probably thinking about, that we'll hear, and being able to document that in values. And those values are the collateral, right, for these loans. And so a lot of it, I think, comes back down to that.
Okay. All right, Jim, thank you. This is great information. So I guess we'll expand our view a bit. I'm going to turn over to Carlos. So we'll go from buildings to infrastructure, but I think there are some similarities in terms of the investigation, understanding more about asset valuation. But Carlos's work and the colleagues he's working with is taking more of a forward-looking view. So Carlos, take it away. Thank you.
Matthew, thank you so much, and thank you everyone on the line for making the time to listen to us today. I must say that I both love and hate to have a previous speaker that is so excellent in the perspectives, and I hate it because it changes my script absolutely. But there's so much and so good that Jim just touched on that I really welcome the challenge. I'm gonna attempt that. But first of all, let me introduce myself. So yeah, Carlos, as I said, Willie Stars what's I'm the executive director of the Commercial Investment, which at this point in time represents 94 institutions. Can you hear me, Matt? Apologies. Can you hear me? No.
It's breaking up slightly.
Hello? Okay, can you hear me?
Yeah, no, that's better. Thank you.
Okay. Otherwise, I would suggest that we move on to Mervyn, and I will try to reconnect later. But please let me know if there are more issues. So, as I was saying, Coalition for Climate Resilient Investment now representing 94 institutions that represent 16 trillion in assets, and that are committed to advance very practical solutions for a better integration of physical climate risk in asset valuation practices, particularly for infrastructure. Additionally, also have the pleasure to be part of Governor Newsom's in California, so the state of California Climate Risk Disclosure Advisory Group that is very much working on the topic with a particular focus and mandate on physical climate risk, and also to Vice Chair CFA UK's panel that is advancing the first certification on climate and investing. So really a lot happening, and a way to really represent the fantastic work that speakers here are putting on the table. So with that, let me bring it back to the Coalition for Climate Resilient Investment. And if I may ask you, Matthew, to go to the next slide, that would be great. Because I'm gonna start zooming in 100% instead of giving you a broad perspective of who's part of the coalition, where are the working groups. I'm gonna go to one of the working groups, as alluded by Matthew. That is the Asset Design and Structuring Working Group. This working group is aiming to develop, and is currently working on developing, a framework for a very granular integration of physical climate risk in investment decision making. And that is where many of the points that Jim raised become so critical. I really loved your point about valuation and about integrating physical climate risk in investment decision making. It is very vague, but what do we mean? Is it an early due diligence exercise where we get an A or grade, an A or A, and then we go into more traditional asset valuation practices, so not considering physical climate risk there? Or are we really interrogating each and every line in that cash flow model and each and every column so that we can obtain an asset value adjustment, which is essentially what we want to obtain? At this point, I think I should mention that One of the reasons we are getting this support, and it's growing because just a few months ago we were only 40 institutions representing 6 trillion in assets. So we are more than doubling in a few months, and we're expecting to keep doing so. And one of the reasons for that is that we are framing this as a valuation risk. And the valuation risk has been the result of how regulatory initiatives are evolving at an excellent pace. So we are seeing a point in time where physical climate risk disclosure is going to be mandatory, and it's going to really guide to avoid unacceptable levels of risk. But also we see how rating agencies, and I think that we have a wonderful representation of that today, are also even further refining their ability to capture and better price physical climate risk in their methodology. So there will also be that, apart from the enforcement, there will be also the reward component in terms of cost of capital. And all of that coupled by the exponential growth in climate risk analytics. So a growing number of institutional investors are recognizing that there is a valuation risk. There is a risk that in a year, 2 years, 3 years, there will be a correction in asset valuation practices, and associated to that, they could see their portfolio's balance sheet corrected without necessarily even suffering a climatic impact. So they see that from an opportunity standpoint, from almost like, say, an arbitrage standpoint. So if we have an advanced view into how those things are going to happen, we can certainly adjust our portfolios so that they are ready when that correction happens. And the other point that Jim raised that I think is critical is the time horizons and the role of analytics. And very important point that he raised, that we normally think that we struggle to understand risk on a 5-year, 10-year, 15-year basis. And that is certainly true. But one thing that he raised is that we even struggle to understand current exposure levels. So what 1 in 100 5 years ago it is today. We tend to think that it's a very minor adjustment to 1 in 100, but the reality may be quite different to that. And building on what also Jim said, when we put this into a terminal value basis, what we see is that 1 in 100 in a 1 year time, which is 1% of a chance, but in a given year, if we keep adding that, and that probably keeps growing over time, you may see that a certain event of a certain magnitude over the next 15 years, that is your holding period, may have a 10% chance of occurring instead of that 1% chance. So that is very different when we calculate and discount cash flows in a certain exercise. So really wanted to bring light to those very valuable points from by Jim. So this working group is doing the following. So it's structured in these sub-working groups or modules, as we call it them. And each of them, as they are quite self-explanatory, they have a very specific mandate, and this is to interpret climate risk analytics for the purpose of those specific cells in the cash flow model. So revenue impact, macro indicators, business interruption, so not the loss and damage, but the decrease in revenue, network effects, and I think that has also been alluded by Jim and Matthew. So indirect impacts and direct exposure without necessarily experiencing that event, and changes in user preference, which is an increasing consideration when it comes to infrastructure. So let's put an airport going to a location that is increasingly too hot. So we may foresee less and less travel to that area. Then is there engineering, and also to that Jim alluded to, that is CapEx, OpEx, depreciation. We need to start understanding, and that is a very particular output in this exercise, what for a given CapEx, what is the climate-related OpEx for the lifespan of that asset? And associated to that, what could be a delta CapEx? So what could be an efficient increase in CapEx that alleviates the exposure or the fragility curve of that asset? And then from there, we go to insurability, where we are rethinking the role of risk transfer. So not to allocate risk on a short-term duration basis, but actually to enhance cash flow predictability. And for that, there is great scope for innovation. And then we go to the absolute heart of this working group and of the coalition, that is cost of capital. And this has been already mentioned by other speakers. Unless we change the narrative about credit quality, risk spread, cost of capital, discount rates, or weighted average cost of capital, we are certainly not moving the needle. And we believe that can be done. So this module is specifically working on that. It's working on how an increase in CapEx is currently properly rewarded or recognized in terms of reduced cost of capital, and how a good practice could look like in the future, and then interpretations in terms of cost of debt and cost of equity, and of course, back to work. And then, of course, asset valuation, that is the ultimate validation that this exercise speaks about financial materiality. So, Matthew, thank you very much. Can we move, please, to the next slide? And in the next slide, you just see the participants. And you will recognize, of course, important brands. What is remarkable and beyond our expectations is that I could name 5 institutions that you see in the screen that are coming to every working session with 5, 6 colleagues. And that has been over not 1, 2 meetings, but actually 29 meetings that we have had for this working group. The other remarkable point is that the climate risk data providers that are participating are doing so on a pro bono basis, and they're sharing very, very sensitive IP, and they are collaborating with each other to deliver for each case study a specific assessment. So if we go to the next slide, I can start showing you a little bit of the process and where we are. Unfortunately, there is some of the actual work that I would love to share with you is bounded by an MOU, so there's sensitivity about some of the projects. But what I can represent very comfortably is that we have access to 40 projects worldwide, for which we have fully functioning cash flow models with underlying assumptions, for which we have full engineering studies. Those have been filtered to 9 initial, properly diversified by infrastructure asset type, hazard, region, and capital structure and stage of the investment. And in those, we're already working on 3, 1 in Africa, 1 in Asia, and 1 in continental Europe, where we are already adjusting the cash flow model. So in essence, we are going to present for each of those, and ideally, if COP is postponed to next year, we are, must say, a flagship COP initiative, we want to present 30 projects, 30 case studies upon which to extract relevant findings. And for each of them, we will have cash flow model A, the one given to us, and then cash flow model B with a granular view into the adjustment in each of those lines. And then associated to that, a framework. If we can go to the next slide, thank you very much, Matthew. And this is, let's say, conceptually, but increasingly empirically, what we are delivering. So from a traditional J-curve, where here is represented by a continuous line, where, for level of CapEx, you have a level of OpEx and a level of revenue. We want to prove that resilient projects are not more expensive projects and then more unattractive projects. Sorry. We want to prove that these projects are more reliable sources of future cash flows, and accordingly that it makes sense. And we are not only drawing these 2 lines, actually we are dissecting those little arrows, the cost arrow and the benefit arrow. Because the cost arrow, there can be many components within that. It can be CapEx, it can be premium, it can be issuance, it can be feasibility studies. So there are many things that we need to better understand. And then on the benefit side, it can be reduced cost of capital, it can be new revenue streams, it can be more certain revenue streams, i.e. arbitrage. So certainly we are already seeing that in those initial case studies, and that is quite exciting. I believe that is the last slide, Matthew. Maybe we can check, although maybe there was, yes. So if I may, with that, and conscious of time, I will leave it there. I will say that the coalition is an open doors institution, and these fellow speakers here would be fantastic additions to that. So please, as well as the audience, reach out to us. This is an ongoing journey, a very rigorous one, where we are starting to obtain very valuable findings. I will finish also by saying that we just received a communication that the G7 issued a communique speaking about CCRI, so really welcoming this initiative and encouraging institutions to join. So please do. I will also work with governments, and that is a whole different story, equally exciting, where we are developing a metric for systemic resilience, as we call it. So a metric that will enable a government to understand how macro indicators are exposed to physical climate risk in a given time horizon. So something that particularly to Mervyn may be of interest. But I should stop there. Thank you very much. And I'm back to you, Matthew.
Carlos, thanks so much. That was great. I think during the Q&A, maybe we can get back to some of these cost and benefit issues that you've raised and some of the investigation into that. Before I turn to Mervyn, can you say anything, Carlos, about, for example, participating institutions in the region or growth that you're seeing in terms of interested, whether they be financial institutions or governments in the region to this work?
So absolutely. So three key types of institutions with whom we are discussing, and those are monetary authorities in governments in countries in the region, large asset owners, pension funds, and infrastructure asset managers. We believe that the region needs to be an absolutely central one to CCRI because, as we know, and you know that more than me, it's a region where we have the confluence of very important levels of exposure with very high levels of concentrations of economic production. That world supply chains depend in some instances of the region. So that is where we see the support. We are the Asian Institutional Investor Group on Climate Change. Is a very core partner to CCRI. Fidelity Investments is also part of CCRI. In Australia, Australian Super is part of CCRI. The Australian government is a very strong supporter of CCRI, as it is the Canadian government, Jamaica, Antigua and Barbuda, UK, and California. But certainly, back to your question, we see a growth in interest and membership coming from the region, but we believe that there's still a way forward. So certainly, those in the audience that have the interest, please feel free to reach out. Thank you, Matthew, for the question.
Okay, perfect. Thanks so much, Carlos. Mervyn, you've been waiting very patiently. So let me turn it over to you. I will advance the slide. Grateful for your participation. We look forward to hearing from you. Thanks.
Thank you, Matthew. Waiting patiently, listening to some fantastic ideas and views already expressed by my co-speakers. And like Carlos said, there is both advantages and disadvantages speaking after great speakers, because they've already covered a lot of the concepts that are important when it comes to physical climate risk. In terms of my role, I am a head of ESG research at Fitch, a credit rating agency, and our bread and butter is thinking about credit worthiness of bond securities and loans, fixed income instruments. Now, I'm not an infrastructure expert like Carlos or a commercial real estate expert like Jim. I think one advantage that I have with my role is that I can see a lot of different things happening across sectors. Because when we're thinking about property and infrastructure, it's not just important for investors in those assets. Banks are involved in lending, insurers are involved in providing insurance, lots of corporates own individual real estate assets. The reach of physical climate risk can hit all sorts of credits that we're thinking about. And I think Jim mentioned the securitization world, also a really important one where property is a big part of our analysis. I think one of the key areas that I think Jim mentioned was if we just did back testing on physical risk, you do end up getting this situation where values do bounce back. And I think that's kind of intuitively a very clear idea, right? Because when we're thinking, if we're just looking at the potential impact of natural disasters, things like insurance come into play and they offset some of the value loss. Things get rebuilt. If you're just thinking about natural disasters in isolation or catastrophe risk in isolation, things recover. I think where things have changed and why Fitch and I think other financial market participants are spending much more time looking at physical climate risk is this is climate change happening. So we're not talking about a randomized change in climate risk. We're talking about an increase in the frequency and severity of natural disasters, as well as more gradual climate changes which have impacts. So be it hotter climates, be it higher sea levels. And once we start thinking about that, we realize the insurance market is not going to look like what it is in 20 years' time. Banks are not going to do the same kind of financing, and it'll be under different regulation. There's going to be a lot of things now that is going to be different now versus what is in the future. And the things that led to property values bouncing back are not necessarily going to be in place in 20 years' time. So how do we answer that question? Matthew, we can jump on the next slide. So we have over 1,500 analysts globally, and we, as part of our ESG relevance score, kind of really thinking about how ESG affects credit ratings, they've been thinking about how ESG issues affects individual credits. One of them is exposures to environmental impact. So that's where we categorize most of this physical climate risk. And we asked them, how does it affect your credit? And what we realize is that the answer is really complicated. It's not just about identifying what that environmental risk is, it's how that environmental risk intertwines with the credit criteria and the credit measures that we're looking at, and then how resilient is that particular company to that particular issue. So let's take an example of, so I think Carlos mentioned monetary authorities. They are definitely paying a lot more attention to physical climate risk. That means we're seeing stress testing on physical climate risk exposure. And we do believe that, not immediately, but over time, that's going to lead to prudential requirements that are related to physical climate risk for banks. What that means is there'll be higher capital charge for that potential physical risk exposure. And that's going to lead to how they allocate their lending book and their investment book, and then impact the cost of funding, either for the real estate entity itself or infrastructure entity itself, or companies that are involved in some way. Now, when we think about that, that's clearly a potential impact on cash flows, on operations, on liquidity. But for each individual entity or asset, their exposure to that risk might be different. If I have a state-owned entity with a government funding very much backed up, my exposure to that bank financing risk is going to be different to an asset that's very, very focused on private funding. So we have to take these things into account. This financing picture will also depend on how the insurance market changes in the future. So right now, when we talk to kind of the different insurers that we rate, catastrophe is typically short-term, right? 12-month type contracts. And so people can get catastrophe insurance. And when there is an incident, they get paid out. We've seen those premiums fluctuate over time. But again, we're seeing regulatory changes at what insurers are doing. We're seeing differences in how insurers are applying their climate risk models. And so we can get a world where insurance for physical climate risk could either become much more expensive or not available at all. And then that's when you start questioning, oh, do sovereigns have to step in? And if there'll be certain sovereigns that aren't able to step in, do we need a global type agreement where there is risk sharing across many, many nations, for example, through a multilateral organization? But whether insurance is available will affect banks' decision to finance a particular asset, because that would affect their own risk profile. And we have to take all that into account. And so for us, what we have been doing, and I think you'll hear about this with environmental risk and ESG, is we're getting as much of the data as we can to be able to think about that risk exposure side more effectively. So take an example of, let's say, structured finance, RMBS in the US, where we've seen that hurricane activity. We are investing in the access to data models when it comes to better assessment of hurricanes. And we're adjusting our loss models, the way that we think about the amount of collaterals needed for particular transactions when we are rating those assets. But there's kind of a lot of things that what we've realized in terms of, let's say, immediate credit impact is if we're looking at RMBS across our book, the amount of times when physical climate risk has actually had a credit rating impact, at least currently in that 3 to 5 year timeframe that we typically look at, is pretty in terms of our forecast, it's pretty small. And the reason is because there is a significant amount of geographical diversification. So if you do have a transaction that is very focused on, let's say, Puerto Rico or Florida, that's very different to, say, an RMBS transaction that has broad diversification around the US. And so this is, again, this is what we've seen so far. But again, things can evolve in the future, because as we're thinking about climate change, we're not talking about changes in individual incidences of natural disaster. We're going to see a severity and frequency of natural disasters increasing in a correlated manner. It's going to be a systemic effect. And so some of these diversification benefits aren't going to be the same if we're thinking about it in a 20, 30-year outlook versus what we have seen in a shorter 3 to 5 year timeframe. Again, something we're paying more attention to. We're also working and talking to corporates on just some of the some of the potential environmental risks and how they can translate in ways that we don't expect. So take the example of something like what we've seen in Taiwan with semiconductors. And we've seen a global semiconductor shortage. There's a huge number of reasons for the semiconductor shortage. There's a huge demand because electric vehicles and various other sources of demand are there that weren't there before, and supplies, it's hard for supply to meet that. But one of the drivers of the challenges is water shortage. We've seen droughts pick up in Taiwan. Semiconductors is a very water intensive business. We've seen the government be able to divert some of that water towards the semiconductor industry, but at the expense of households and business through a rationing process. Now, this is a fix that is function, so that the credit impact overall on that is relatively low, at least for now. But it's a demonstration of some of the government policy challenges that will materialize in the future to deal with some of these physical climate risks. So that's the kind of point when environmental risk can translate to social risk as well, because if you start having to share the burden, you may end up having costs to put for the rest of society, and then the response on that cost may not necessarily be, it may lead to unrest and tension. So there's a huge amount of things that we need to consider from just the potential for increased physical climate risk beyond just that direct impact on property values or infrastructure values. I'll hold there for now and pass it back to you, Matthew.
Marvin, thank you. That's great. I'm going to stop sharing this screen and bring us all back to a bigger view here. Any sort of closing or concluding reflections about weaving the ideas together from what you've heard from the others?
I think what is going to be a big conversation here in the EU and APAC and elsewhere, and we're seeing this more and more, is how physical climate risk and other sustainability issues will be governed. So the governance of these issues, how will boards change? How would they get the adequate expertise to be able to even get a grasp of all these complexities that we're talking about be it transition or physical climate change or transition or physical climate risk? And I think it's that governance component that's actually going to be very, very key for us to actually be able to solve some of these time consistency and other economic issues.
And let me just build on that, because I think that is a critical point, and one in which actually CCRI spends a lot of time in kind of developing a very bespoke case for the different actors in the system. Because of course, the incentives for action for a government, and let's say the need for a political return, because that is a concept here for a policy decision maker to really obtain a return on a decision vis-a-vis other non-climatic decisions that are available, is critical.
Risk is very binary for some, even though we tend to think of it as continuous or maybe discrete with scenarios. But there are some institutions that will not invest in real estate in Florida whatsoever, right? It's just redlined, and they're worried about stranded assets. But then from a social aspect, you're starting to see climate gentrification, right? With wealthy folks moving away from the coast and gentrifying previously lower income areas. And now those people are displaced for completely different reasons than you ever would have thought about. And that's a real concern for cities. So I'll stop there.
Jim, thank you. Thank you to all. So, I mean, I think, we're hearing about the importance of governance, corporate governments, public governments, collaboration, public and private. There's a lot of complexities to these issues. The interconnections are becoming or will become more clear or laid bare, I think, by some of the risks that we're facing. But I think, to Carlos's point, we can take some, it's a challenging issue, but we can take some solace as well that that there are good people like you all and many of the people listening today that are really dedicating the time, the energy, the intellectual capacity, and the resources to thinking through how the landscape is shifting and what needs to be done to support value creation. So with that, I will thank each of you, Mervyn, Jim, Carlos. Very, very grateful for your contributions. I think this has been a super discussion. I wish, as Jim said, we could have more time. But then thank all of you for listening today, and we wish you a good rest of the day. Thank you. Goodbye.
Thanks, everybody.
Thank you so much. Bye-bye.